let's kick it off. So I just wanted to welcome everybody. Thank you very much for joining David and I. We're very excited to have you join us today as we learn more about how we can improve here from, how to run businesses, right, and how to make better business decisions. And so very excited with David. David joining us. David, thank you so much that you're coming to share your years of knowledge and expertise with us, and also sharing with us how you've changed organizations. And so I'm very excited about the session, and very excited to be having and joining you on the session.
Yeah.
So just very quickly, so just hear from I'll quickly share a bit about myself here. So I'm Chris Meyer, and Fanatical Software. So we are a software company. We specialize in Excel add-in and reporting, from QuickBooks Online to Microsoft Excel. We're the #1 Excel add-in, for QuickBooks Online. And so from my background, I've been, I'm a chartered accountant. The accent is South African, so I qualified in South Africa. From there, about 20 years ago, I found myself, in the US, and I've been, working here in the US for the past since 2001. But very much transitioned over into the tech space, and have been involved in financial reporting, business analytics for, I'm gonna say, most of my career, actually. And involved in various startups and businesses, really focused in this specific area, financial reporting, and how to improve business decision making. So thank you very much, and great to get to know all of you a bit better. David.
Yeah, thank you. And Chris, capping off your career, you created a very cool tool that we're going to get to talk about today. But I'm David Worrell. By day, I'm a fractional CFO and financial analyst. I've done public equity analysis back in the day, but these days I'm focused very squarely on the small and medium businesses, anywhere from pre-revenue startups to maybe $50 million in revenue. And along the way somewhere, I wrote a book called The Entrepreneur's Guide to Financial Statements. It's technically a textbook, I guess, but I think that most people would find some easy to understand lessons in there. It's written from an entrepreneur's point of view, not for an accounting major or an accountant. It's written for a business owner to be able to learn how to use financial statements. And of course, that's exactly what we're going to talk about today. My company, Fuse CFO, provides CFOs, controllers, and accountants on a fractional use basis. Use this as much as you want or as little as you need, but we can be your outsourced finance and accounting department. And we do not do taxes. Happy to refer you to somebody, but we are a management accounting firm. So doing these kinds of dashboards and analysis that we're going to talk about today is really what we do day and night. And I love digging into a person's business, an entrepreneur's company, and telling them what's going on behind the curtain, right? And so as a business owner myself, I know we get involved in the day-to-day operations, and we sometimes forget to kind of look through the weeds and get a better visualization of what the company is trying to tell us about the operations. So that's what we're going to do today. So what problem are we trying to solve? What problem is Greg Crabtree trying to solve when he wrote the book Simple Numbers? I think that the fundamental problem that I have as a business owner, that the business owners I meet have, is that we need better information. And note that I didn't say data. We're swimming in data, right? But we need better information because we need to make decisions. We need to use the data that we've got to make decisions. And in order to do that, you've got to turn all of the numbers that are in your accounting system or in your operation system into information to help you make a decision. You also like to be able to talk to each other about it and talk to consultants like me or fellow business owners at a cocktail party about your data and information. And to do that, you need a common vocabulary. And unfortunately, QuickBooks Online is not much help. No fundamental accounting system is really much help in the information segment, because everybody does their own books their own way, which is great, by the way, and something I recommend and help people do is tweak their books to be meaningful for them. But the more you customize your QuickBooks, the less commonality you have with other business owners, and so you lack a way to talk about it. Let's go to the next slide, and you'll see that, of course, we could just go into QuickBooks Online and print financial statements, but unless you are a CPA, you might not get very much out of your financial statements. There's lots of raw data, but they don't come with any basic analysis. And QuickBooks is certainly not going to tell you, hey, in order to improve your cash flow, you really ought to consider using ACH to collect your debts ahead of time, right? I mean, it's like my favorite piece of advice to anybody is collect your debts, collect your invoices faster, and ACH is a great way to do that. But you're not going to get advice like that out of QuickBooks. You also don't get any analysis. There's no ratios or trend lines or comparisons to other companies in the native QuickBooks. There's a smattering of this stuff, and they're starting to get a little bit better. They've got a little AI tool they're trying to trot out. But in general, you're looking at stuff that's not very meaningful to you. I really don't use the QuickBooks dashboard at all. But next slide, Chris. We do have spreadsheets. But spreadsheets can cause analysis paralysis, right? If you were looking at the spreadsheet that's in the picture on this slide, I wouldn't blame you if you went cross-eyed because, for example, I run an accounting business and we measure our productivity per employee. I looked at 12 different ways to measure productivity per employee. There's billing rate, there's utilization rate, there's effective billing rate, there's, all these kinds of things. And you end up with so many ways to measure stuff or a dashboard that takes up 12 tabs on a spreadsheet that you end up with analysis paralysis. So again, we're looking for a simple way to do that. What does an entrepreneur want to know from his business? I'd love to hear your questions, but here are some of my favorites, right? How much product can I produce? Or in my case, how many hours of accounting can I sell? Do my employees have good tools to get that done? Do I have too many managers? Are we top heavy? Am I selling enough for my existing infrastructure? And how much should I invest in my company? How much do I already have invested in my company? So there's kind of these three big areas of analysis that will help a small business owner get the most out of his company. And that is an analysis around the operations. How efficient and effective are your operations? Analysis around management. What kind of a job are you doing as the manager? Or maybe you have, some middle managers. How effective are they at organizing the work, at giving people the tools, at bringing it all together and making sure it gets billed out and paid? And finally, money. How efficiently are you using your capital? Are there opportunities for you to invest more capital? Are you maybe over invested in capital? And using the actual dollars as an important input into your business to grow your company. So you can read some of those questions, and I'm sure that you have others, but operations management and money are the three key areas where you want answers. So believe it or not, all of those questions I put on that last slide can be answered by just three numbers. And this is the magic of the simple numbers framework, if you will. Greg Crabtree came up with basically three numbers. Now, we're going to see a few more today, but the three numbers he loves are direct labor efficiency ratio, and I'm going to go deeper into this in a second, but direct labor efficiency ratio, management labor efficiency ratio, and return on invested capital. And today we're going to learn how to look at each one of those things, interpret it, what's it mean to the operations or the management or the money in my business, and how to take action on that. So let's go to the next slide. And that's, again, just to pump Greg up a little bit, it is a great book. He boils it all down to these three powerful metrics. He gives us all a common vocabulary, and he gives us also some really serious benchmarks because within his business, he has 400 or 500 clients, and he has taken the averages of those three metrics for lots of different companies over his career. And so you can learn very quickly where you stand in relation to kind of best practices and the most efficient companies that at least that Greg has dealt with. So let's go to the next slide. And that I think is the three. Oh, sorry, how it works. A little peek behind the scenes for Greg's work. Number one, Simple Numbers does take fundamental results or fundamental inputs from your P&L and your balance sheet. So there's no new numbers you have to come up with. This pulls data from QuickBooks and puts it into a common math framework. Every company's got these numbers that you need. And because it boils it all down, it simplifies it into the fewest number of moving parts in order just to really start the conversation. So results are a spreadsheet, right? We're going to look at an example spreadsheet today, but you'll end up with a spreadsheet that tells you those numbers, and the same numbers measured the same way over a number of months gives you the consistency you need. It's easy to calculate. And when you're done, you can look at both the numbers themselves and the trend lines. Trend lines are really important when you're doing financial analysis. So look at the numbers themselves and the trend lines, see the directionality, get some insight, and start a conversation about what's moving the needle in the right direction. Or maybe it's moving in the wrong direction, right? But what's moving the needle on these things? And how do I operationalize? How do I make decisions and changes in my business that will then be reflected in improving numbers within the simple numbers framework? I think you'll see all of that today. Again, I'll review these 3 key metrics. These are going to be really important. We're going to look at them in a spreadsheet, but direct labor efficiency ratio means literally for each dollar I pay to my frontline staff. Now you can think of these as people standing on an assembly line, people doing accounting and consulting work, people at the Burger King, behind point of sale, behind the counter, whatever people are directly impacting your revenue, right? Maybe they're in the warehouse, pick, packing, and shipping, whatever that is. The direct labor efficiency ratio says for each dollar I pay to my staff, how many dollars of revenue, actually gross margin, do I get in the door? How many dollars of gross margin are my staff producing? For me, revenue and gross margin are almost the same thing because I'm selling services, right? So I might stumble over that, but I'll show you the difference. If you're selling products out of the back, we don't measure how many products that guy in the warehouse can get out the door. What we're measuring is what's the gross margin on those products that he gets out the door, and how much gross margin can he generate. And that'll be important. We'll see some reasons why that's important later. Management labor efficiency ratio, MLER, says, okay, now the managers are in charge of giving tools and setting up processes and hiring the right people. And so we're going to measure their efficiency based on how many, for each dollar that you pay to a manager. And by the way, if you're the entrepreneur, that might include yourself. So for each dollar I take home, how much contribution margin can I generate? And contribution margin in this case is gross margin minus the direct labor cost. And don't get too worried about the details. We're going to see a spreadsheet. But the management labor says, think of it this way, what's the profit after I pay my frontline staff? Because that's what the manager is really managing. How much profit is left after that frontline staff, that warehouse worker, that accountant, after they take home their salaries, how much is left? And that's my job as a manager, is to optimize and maximize the profit left after I pay my frontline staff. And then finally, we look at things a completely different way, and we say, how much money is in my business today? How much cash have I actually invested? How much do I need to keep the doors open? And how much am I making as a return on investment from that investment that I put into my business, right? You can make 4% in a bank account. You can make 10 or 15% in the stock market. What's the return on invested capital in your company? Should you be putting more money into it, or maybe not? And what direction is that going? So the next slide is, I believe.
David, yeah, so just a quick comment here. I think just what's so great, is that you mentioned in that first ratio, the DLER, is that it really transcends different industries, right? I mean, I think it's not the traditional, we'll say, direct labor manufacturing. I mean, I think this ratio really transcends various industries and is useful across all industries.
Yeah. This is a common vocabulary for every business in the world. You can even analyze Dell Computer or American Airlines or Microsoft on these things. Doesn't matter what you make or what service you provide. We have a common vocabulary to talk about this. And you can compare with your friends, right? And you can say, oh my God, Chris, my DLER is only 1.5 and it should be 3. What are you doing to get your DLER up? And you can share strategies that will probably work across most industries.
Yeah. And that management labor, I mean, that could bring us into trouble, right? I mean, I think because that really is a management efficiency ratio that is then calculated.
it's really easy to get top heavy in a small business, right? You can hire a CFO, and you can hire a operations manager, and you can hire an admin and an office manager and a private secretary and a personal assistant. Pretty soon you got a lot of admin and not so much growth to support them. Yeah.
And then, I mean, I think just to reconfirm, so like the return on invested capital, that really is almost, if I have extra cash, do I actually invest it in my own company, or do I try and invest it in the stock market or something else?
That's right. That's right.
Okay.
All right, you ready to see an example, Chris? We've got a good one. This example is a real life customer, which is why you will not see their business name. I'm trying to protect the innocent, but this is a event space. It's a retail store where children can go and have birthday parties and jump on the trampolines and the bouncy houses, as displayed in this awesome AI generated graphic to the right side here. And the questions that this entrepreneur had for me was, am I pricing my parties right? So if you come in for a 3-hour birthday party at my location, how much should I be charging for that? And am I pricing it correctly? Can I afford to hire a manager? And what would that do? And then how much can I spend on marketing? You know, really common questions. And all of these things can be answered by our analysis. So Chris is going to switch over to Excel now, and we're going to see an actual simple numbers analysis of this birthday party event space. And you'll notice on the tabs on the bottom, there are two main tabs, the P&L, which is the profit and loss statement of any business, right, or income. And then there's also a tab called capital, and that's the balance sheet. And we're going to do a completely different, that's where the money analysis starts on the capital page. But P&L, remember, we want to talk about people and operations and management, right? So the people side of this lives in the P&L. Now, to get to those ratios that we talked about, it's really important that we take whatever chart of accounts, whatever income statement you have created for your business, and we start to find that common vocabulary, and we boil it down, and we use only the numbers that the framework demands. And in this case, the numbers that the framework needs to work, the numbers that Simple Numbers needs to work on this spreadsheet, is your top line revenue. I should say your total revenue after returns and allowances. If you're in a product business and you get 10% returns from Amazon, you got to take all that out. So your monthly gross revenue after returns and allowances. Cost of goods sold, and that means different things for different people, but that's only the actual, goods that you are buying to perform your services. I actually have cost of goods sold in my business. Of course, usually you would say an accountant cost of goods sold is labor. That's not what this means. This means things that I have to buy in order to do for my accountants to do their job. In my case, it's the customer's subscription to QuickBooks, which I resell to him. In the party place, the analogy is pizza and soda pop. I'm from Ohio. We say pop in Ohio. Do you ever say pop in South Africa, Chris?
No, but we do it in Pennsylvania, right? So that's the Midwest term, right? So.
Awesome. So the party place has to buy soda and pizza that they then resell. The cost of those goods has to come out of revenue to get you what's called gross margin. That's the part of the equation that your frontline employees can control. They can control the amount of Pepsi that they put into a cup, or the size of the slices, or how much they sell to a customer, but they can't really control the cost of those. Well, they can control the cost by not giving free refills and making sure that the soda gets charged for and all of that. So that's where they have some control, and that's why you're measuring the direct labor efficiency ratio to say my frontline staff controls my gross margin. What return am I getting on my frontline staff's wages? So direct labor. Now, let me point something out. A lot of my clients, they only have one line in their P&L for wages. They get a report back from ADP or one of the payroll companies that just says your wages were $37,000. Yeah, great, but some of that's frontline staff and some of that is management staff. Some of it's business owner staff. Maybe you're paying your child who doesn't even work in the business. You got to pull all that out. We really only want the direct labor, those people who are customer facing and making money for the business. So that might be an adjustment that you have to make. And by the way, a little sneak preview here. That's a really good reason to use something like what the Fanatical tool, because you can do some of those calculations in the background automatically each time. Anyway, direct labor costs. So let's look at column M, the first one there. That's easy to see. The direct labor costs $27,000, and they generated gross margin of $135,000. And so to get DLER, put your cursor in line 16 where the DLER is. You'll see that's just a really simple division. Yeah, it's 27,000 divided by 137,000 divided by 27. We're going for a big number. And so you hope that you invested 27,000 in their salaries and they generated 135. That would give you a direct labor efficiency ratio of 5. Now, normally 5 is an outstanding result in this thing. And again, we could tell you the benchmarks for different industries. But think about what's going on here. This woman uses very little labor. Mostly what she's selling is the space, right? The time and the space inside this event facility. So it's not surprising that she has a 5 DLER. You may find that you've only got a 1 or 2 or 3. Well, I hope it's not 1. You might find that you only have a 2 or 3. In accounting, we shoot for a 2 to 2.5. So if I pay my people $50, I want them to generate $100 of gross margin. Now, along the way, these spreadsheets are set up to show you things that are interesting, like gross margin as a percentage of sales. But sometimes that matters, sometimes it doesn't. It doesn't really matter for me. It doesn't really matter for a bouncy house place. Maybe it's important to you to keep track of, so it's in there. But the thing you're really looking for is direct labor efficiency ratio, and to track that over time. So you can see now, we do this every quarter for this woman, and it's starting to waver a little bit and even drop. So she's gone in the last 13, 12 months, she's gone from 5 to 4.7, back to 5, and we're projecting that this is going to be a bad quarter for her at 4.2. If it's bad, let's just stop and say, so what? Now we know it's a number. So what? Well, the first time you get the number, you might not know very much. But the second time you get the number, you're starting to see a trend. And you can say, okay, what does this mean? Why did your DLER go down? Why are your people less productive? And you can have a conversation with her. And you know what comes out of those conversations is she might say, or I might say, my direct labor efficiency ratio went down this month because people took vacations, because we hired a new person, and 2 of my full-time staff had to stop what they were doing and train this person, meaning they weren't being billable, right? They weren't generating gross margin. They stopped being billable, and they went on a training kick to get this new person up to speed. So you might have vacations, you might have maybe you gave people raises, that would change your DLER. Maybe somebody came back from a maternity leave and you have an extra high salary and you haven't quite filled that person up. So it could be telling you that you have excess capacity. It could be telling you that your people are not working efficiently, or maybe conversely that they are. I've seen businesses where the DLER just keeps going up and up and up. And I say, wow, how far can you take this? What's going on? And the entrepreneur tells me, yeah, my people are literally pulling their hair out. They're working evenings and weekends and nights and overtime to get all the work done. Hey, that's an actionable insight. Now you know it's not just bullshit, excuse my French, that your people really are overworked. You can see it in the numbers. They've got a DLER of 7 and your industry DLER should be at 4. They're working too hard, and it's time for you to start hiring before you burn your staff out. So seems like a real simple number, but it's really actionable when you start using it as a foundation to ask questions. What's going on?
David, and then just very quickly, so you see different numbers across the different industries.
Yeah. Greg Crabtree in the book, he breaks it down into people that sell things. So distributors, resellers, e-commerce sort of stuff. People that make things, manufacturers, manufacturers, people that do things like accountants, And then oddly, he's found that there's this outlier called MSPs, managed service providers
Yeah, yeah.
in the IT industry, who are an amalgam of all three of those things. They often resell products, they sometimes make stuff, they have engineers, they also have recurring months. So he's got a whole separate measurement for MSPs, but generally do, make, or sell is the categories. And the DLAR fluctuates whether you are a do, make, or sell.
Okay, thank you.
Yeah. Let's go to MLER. So I've got a staff, they're working really hard, they're making great gross margin, and I can be very proud that I've hired the right people and given them the right tools, but do I have too many people in the management role for the size company I am? That comes out in the MLER. And this bouncy house may not be the best example of MLER, but it's interesting because she's a very small company. And in quarter 3 of 23, she was not paying herself hardly at all. That's $8,200 salary for her, the owner and manager of the business, over a 3-month period. So she was making less than $3,000 a month. That might not be realistic in your world, but the results are the same. We could see that she was being very efficient for her salary. And it's one indication that, hey, you know what? You need to start paying yourself more to literally bring that number down, to make that number worse, because it's just a little bit out of control. It probably says that you're underpaying yourself. It might also mean, well, we talked about just bloat, right? I have an executive assistant and a payroll clerk and a middle manager and an operations manager. And pretty soon you've got all this management overhead and your management efficiency ratio is going to continue to drop. So you need a target to set for these numbers and use it as a kind of a budget to decide when you should hire more managers and when you should maybe let some people go or decrease bonuses or whatever it is you got to do. In this case, let's go over to where she's at 4.4, a low spot in there, 4.9, sure. What it's also telling us is the amount of sales may not be enough to support that level of management wage. So you really have two choices. You can reduce your management wages if possible, maybe lay some managers off, or you've just built such a solid business that you should be selling a lot more. That's my case. I've got 3 or 4 people in admin, and I should have a $5 million business for the size of the infrastructure that I've built, but I'm struggling to get to that number. And I know in my case, it's all about sales. And if I can't reach those sales, then maybe I need to make some different decisions about the kind of infrastructure I've built and lay some people off. But again, this is a number that we use to ask a question, and you can see it declining. MLAR declined, and you can say, what happened in your business? In this case, we know that she just started paying herself better. 8,000, 12,000, 27,000. The owner started taking home a reasonable salary, and the number likewise declined. But management salary, owner salary always needs to be relative to the number of sales. And of course, in this case, what we're saying is it really should be directly related to contribution margin, because that's what you control, the amount of profit left over after we pay frontline employees. Does that bring up any quick questions, Chris, or anybody in the audience have some questions on DLAR or MLAR?
No, I think it makes perfect sense to me, right? I mean, I think absolutely. And I think, well, if it's a sole operator, maybe you probably have a bit of flexibility in terms of the amount of salaries that you're drawing, right? And, but yeah, I mean, I think if it's larger, the organization, and you start hiring lots of people, I think one probably has to check that metric, I think quite accurately, and maybe the example that you mentioned as well, right? And then there's probably sometimes a lag, right? Sometimes you build infrastructure and then the sales come subsequently, right? So it's not always, and that's probably just where your trend reporting actually becomes very useful, right? So it's like it's maybe an initial investment period, and then as sales go up, I think you can see those metrics actually improving.
Exactly right. And the last thing for me on this is, because you have 2 numbers now, you know whether the problem is in your infrastructure and overhead or in the efficiency of your frontline staff, right? And if it's in no matter where it is, of course, you also have to think about, am I selling enough to keep these people busy? But assuming that in an ideal company, the frontline staff is, full out busy all the time, and you've maximized their productivity, now you know whether the financial problem with your company is in is in the gross margin, meaning are you pricing things correctly?
Mhm.
Are you giving your people the right tools? Or is it in the contribution margin, which says maybe I have too much overhead, maybe I'm not managing efficiently, I'm not hiring the right people, I'm overpaying salaries for the front line. That could be, right? You can increase your contribution margin by reducing staffing costs also, so that there's more left over to come back to
Mhm.
you as manager. So anyway, my point is it just starts a really good conversation. And when you have somebody who understands these numbers intuitively, you can really drill down deeply into your business. Okay, this page finishes off simply with net income so that you can tie it back to your actual P&L and a percentage of sales. Net income as a percentage of sales is going to be important to us later, but people often ask me, what should my net income be as a percentage of my sales? I sell $1 worth of widgets. How much net profit should I have at the end of the day? All my expenses are paid, all my overhead is done, all my wages, including my personal salary, are out. What should be left over? And the answer is 10% will keep you alive, 20% will make you thrive, right? So everyone in the world should have a 10% net profit margin if they're running a healthy business. And if you got a great business, 20% is a reasonable goal. Now there's some outliers. Microsoft or a pure software company, a SaaS company can have much higher net profit margins. But for those of us in the real world, 10% will keep you alive, 20% helps you thrive. I just
Very
made
cool.
I just made that up, by the way. Should I write?
Hey, it sounds good to me.
All right.
I think we'll quote you on that one next time, David.
Yeah, good. Good. Let's shift. So we've talked about operations and management. Now let's shift to money real quick, and then I'm going to turn it over to you. That's the well.
David, what did you briefly want to mention just a bit about the what if scenario?
Oh, of
Yeah, we
course.
just basically just a bit of calculations and not trying to make it too complicated, but yeah, so just when sitting with a customer and maybe talk a bit, just brainstorming different scenarios that
Exactly.
how to very quickly, you can almost just project a couple of scenarios, right?
Yeah, this spreadsheet is so simple, and when it's combined with Fanatical, it makes it so easy to do these lookups that you can play what if all day long. What if I hired a new person? What if I increased my revenue? What if I spent more on marketing? All those things can be thought through on here by saying, well, which bucket would they fall into? If I want to increase revenue, obviously that's top line stuff. If I give people a raise, or I hire some new employees, that's direct labor. And so you can build a little what if model that just adds these presumptions, these new ideas, your strategic ideas. Just take that number and add it to your last quarter's results and see what it would have done if you'd hired that person 3 months ago. What would your DLER do? Would it go up or down? And so in this case, we're like, well, I can hire $10,000 worth of new employees, and that will help me get $12,000 worth of sales. Is that better or worse? Okay, there you go. $15,000 worth of sales on $10,000 worth of employees. Sounds like a good deal. I'm going to invest 10 and I'm going to get 15. But you know what? My DLER is actually going in the wrong direction. So you got to know if you hire $10,000 worth of employees, you really should be bumping your revenue by more like $40,000 or $50,000 in order to stay at that 4x rate, right? So what are you going to do? How are you going to spend your money to hire the right kinds of employees that are going to increase your revenue by your desired DLER, 3x or 2x or 4x, whatever that is?
Yep, and obviously in this example here, I mean, we're keeping the calculations fairly basic, but you can create a mathematical ratio between those, but not to always get too overcomplicated, but it allows for just various scenarios.
Yeah, well, if you want a 4.0 DLER and you spend $10,000 on new employees, 10 times 4 is $40,000 of new revenue you've got to get with those new employees, or you're going to impact your ratios in the wrong direction. And that's going to be really important. That's a really good segue to the capital. Yeah, let's look at the graph for just a second. I think it's really important. Any financial analysis is graphed, and you see the trend over time. So you can see here that downward spiral of management efficiency is when she started paying herself. Now, maybe 4 is an okay number, but we can at least see the trend and help her manage to keep it at the number that she needs. So really simple graphs can help you see the effect over time. And then going to capital, I'm really only interested in knowing what's my return on capital. Should I invest in those 10,000 employees or not? Or should I invest that $10,000 in new employees or not? And that's figured. This is a little bit esoteric. If there's a hard part of simple numbers, this is it. But the spreadsheet makes it really easy, and linking your spreadsheet with Fanatical will make it easy. You want to know two numbers. You want to know the first one as a percentage of sales at the top. What's your percentage of net income? And we figured that on the other page. So this is just a repeat. In Q3, she was making 10% profit at the end of the day. Everything's paid. Trade capital means how much money is invested in the business. Some people think of this as working capital, but if you add up all the money you've borrowed, that's other people's money, and how much you're spending or how much you have wrapped up in things like inventory and prepaid expenses, that's your own money that you're spending. What's the balance there? So you get credit for borrowing from banks. You also get credit for borrowing from credit cards and from borrowing from your customers. Now you're like, what? Borrowing from my customers? How does that work? Imagine you're an airline and you buy an airline ticket. If you bought an airline ticket this week, is it because you were getting ready to get on the airplane? Probably not, right? You buy these tickets weeks or months in advance, and the airline borrows that money from you. They charge you as soon as you hit buy and lock in that seat. They get to use your money. They've borrowed that for weeks or months. The same for this party house, the event space. She takes reservations months in advance, and she sits on $20,000 to $30,000 of her customers' prepayments for months at a time. That means she doesn't have to come out of pocket to pay for the light bill or the rent check because she's borrowing from her customers. So that's a really neat calculation to do, is how much of my money do I have to put into the company to keep it alive? And then how much of my money have I already invested below there on line 19 into what's called infrastructure or infrastructure capital, property, plant, and equipment. In this case, it's the bouncy houses and the blowers and whatever, the point of sale equipment, all that sort of stuff, property, plant, and equipment. If you've borrowed to buy that sort of thing, you get to subtract that out because, again, you just want to know how much of your own money is invested. And then finally, we add this buffer capital on line 23, which is just a rule. There's no math here almost at all. It just says, how much did you spend on salaries and overhead in the last month? Multiply that times 2 because we think you should have some cash on hand in case the world stops spinning. And, we used to laugh at that. When is the world going to stop spinning? When are my customers going to just dry up and spend zero with me? I'll always have some kind of business. We now know, thanks to COVID and 2020, we now know that the world can stop spinning and you can have to shut your doors for a while at a time. So really important that you keep a couple of months of cash on hand. I don't care for purposes of this, I don't care how much money you actually have on hand. I'm telling you, calculate it at 2 months. Whether you've got 2 days or 2 years, let's calculate it at a standard 2 months, and that gives everybody this common vocabulary, and it's good advice. Keep 2 months worth of cash. So you add all that together, and you get the total required capital that's in your business. This woman has $94,000 invested in her bouncy house company. And because she's making, that's 15% of profit, by the way. I'm sorry, 15% of sales. And so you see that she's got $94,000, but what's her profit again in this quarter, Chris, at the very top? She invested $94,000, but she would earn $66,000 in a standard year. Well, now, this happens behind the scenes, but these numbers are annualized, meaning even though we're using the results from Q3, we've pretended like they're for the whole year in order to kind of standardize. When you talk about balance sheet stuff, you're generally talking about a year. So we think her net income could have been $66,000 with an investment of just 94, meaning her return on capital is 70 something percent, right? That's at the very bottom number, 71% return on capital. Imagine that. Yeah. Can you go to the bank and start a savings account or even a certificate of deposit and get 71%?
I think given that quarter, I think I need to invest in this business, David.
Right? My Tesla stock has not returned 71%. I guarantee you. And so it turns out, and I was shocked when I first learned this, it turns out that, again, to be alive, a business should have a minimum ROIC return of 50%, 50, 50. To really be doing great, we've seen businesses have an annualized return on investment of 150%. I mean, that blows away everything else in the whole world, right? So again, graph it out so you can see what's going on in your business. Use that number to play what if, use it to predict and to evaluate how you're doing in your business. I've kind of eaten up a lot of the hour, Chris. I really can't wait for you to show these people how the numbers get into these graphs. You want to take a swipe at that?
So yeah, so I think just in terms of automation, I think it is just those ratios, what if, I think they help there. And also I think the issue is also just with automation or not having it is that the data can change, right? And just how do you refresh that? And I think, David, I think you've shared, right? I mean, I think there's, if it's manual updates that are required, it's prone to error. And yeah, so I think that is where, just very quickly, I'll just quickly share here about, just Fanatical. And I think that's where we've helped, David, and in terms of sharing and being able to update, the dashboards, for his customer with Flash reports. So Flash reports is that add-in to Microsoft Excel. We're basically, it's a plug-and-play solution. You download it from the App Store, and you're able to log on directly to QuickBooks Online. And we only work with QuickBooks Online, but yeah, it's essentially a very easy front end, just to use with application. And then just to come back to, what we briefly shared here is that in this example over here is that, we can see, this is the actual formula that's used. And so that formula just makes use of cell referencing, for us to, fetch that data from QuickBooks Online. And there's actually a real-time connection. And so here, as a QuickBooks user, you load your add-in, and then you just very quickly connect using your QBO username and password. From an architecture perspective, this is a direct connection to QBO. And so there's a little bit of master data, so company details that is cached locally, but there's no separate database or anything like that at all. Is that we are able to connect directly to QBO, and when we build these formulas or inject these formulas, we're able to reference different periods in order to say populate this formula. And once that's essentially done is when we click this, I just click refresh sheet. That then essentially passes these queries over to QuickBooks Online, goes and fetches those values for us, and then brings it back here into Microsoft Excel. So what we also have with Flash, which is the tool, the reporting tool, is we've got a whole number of these type of what we call summary accounts, parent accounts. And then that enables, for example, we're a grouping of all income in, say, a parent account. And for example, here's all the cost of goods sold accounts, that is essentially, is also grouped together as well. And so this then enables us to, just populate these, say, total values, which makes it ideal for dashboard type of reporting. And I think, as I mentioned, it's very much just real time, right? So there's no time delay. If you had to make any type of posting, within QBO, then if you press this refresh button, then it basically updates, in real time as well. And as David mentioned, just from a graph perspective, and here I've just got that example as well. If we refresh, the data, your graphs and everything is essentially automatically, just updated as well. So one way of populating, the formula is through, I'm going to say, putting in actual accounts. Another way, and this is also just a report that I just quickly, a template report that I brought in, is just through actually referencing accounts, right? So this would be just a standard income statement or P&L. And so here we can see just from a cell referencing perspective, now I'm referencing whatever account I have here in cell A8. And as I move down, there you can see just now that's the account in A11. And so from any reporting or simulation perspective, right, because it just makes use of cell referencing, I can very quickly just copy, right, and paste these values over, right, and create a quick report. Here I can, just put in, let's say, a variance column. And so I'll very quickly do that, right? We haven't got any variances at the moment now because it's exactly the same values. But let me just quickly do that. And maybe from a formatting perspective, I'll just take a couple of columns over there. But now, if I go and change, let's just say here, last year to this year, and let's maybe say, I can take this year to last month. So my list of values function essentially brings up, say, all the dates and parameters that I have in QuickBook. I can just change that. And then, there we can see, I'm basically pulling in new values, for this month, but then any type of actual calculations are automatically updated as well. And so, as we change those dates, let's just say I'm just quickly change that to last quarter. If I can type correctly, and let's maybe say that this is this quarter. And there we can see, any type of calculations is automatically, updated as well. So also from a dashboarding perspective, what we can see that the tool, operates with Excel, and you're able to do any type of calculations and interacts with Excel, any type of calculations, and it also maintains the formatting, that you want, right? So here we can see in this little dashboard or this calculation, we've got some custom coloring formats, even a graph. And when I refresh these values, all of these get recalculated, but my formatting, remains consistent and, remains in place. So yeah, just very quickly, a bit more about Flash reports.
Chris, you know what I love about this connection right now? Number one, take that column P there, and you see that it's April, May, and June, Q2. What if you wanted that to be the year to date, 1/1/24 through June? All you've got to do is change that row 4, right? Make that January. Yeah. Boom. It all updates, and now you can play comparison between a half of a year. And you want to do that for all of those columns you could. But number two, so first thing I love is that it's updatable on the fly, and I can use all of my Excel tools to just play what if all day long. But number two, and more importantly, is I never screw up my QuickBooks, right? I'm not a great accountant, folks. I own an accounting firm. You do not want me doing your QuickBooks. That's why I have 15 people on staff who do accounting much better than I do. I'm an analyst. I like to live in Excel. I like to play in Excel. I like to see the results, but I don't want to know that there were 27 entries for Office Depot buying paper clips, right? I want to say, what's my total paperclip budget for the year or for last year or for next year? And I can do that in Excel without screwing up all of the hard work that my accountant did in QuickBooks. And that is so important. And that's why we give our customers tools like Fanatical instead of inviting them into the QuickBooks data itself. And boy, does that save everybody a lot of heartburn.
Yeah, no, thank you, David. Absolutely. And I think, you with your entrepreneurial mind and, and capabilities in the book that you've written, I think it's also, as you mentioned previously, just the whole what if scenarios, right? And it's taking that forward-looking view. But invariably, when we start taking that forward-looking view, it's so difficult to actually refresh our current data or make any type of calculations or simulations. Right. Or invariably trying to do it in a tool that is, say, fairly easy to understand.
Yeah.
So no, absolutely.
Yeah, I've built models for, venture capital backed companies, and the models tend to be 20 tabs long. And then the guy says, well, what if we hire 2 more people?
Yep.
You got to go in and you got to have version control, and you got to say, no, you're looking at the wrong one, or you screwed up a formula or something. It's truly a nightmare compared to how easy and direct this is to get the answers that you want without doing the hard work of screwing around in an accounting software. Yeah.
No, absolutely. So we're coming up to the end here, but yeah, just from a Flash reporting perspective, I think that if you are interested, we do a 14-day trial. As I mentioned, no middleware. You can go to our website. You can subscribe. You install from the Microsoft App Store, and you can just log on to your own entity and then just import your first report. You should be able to do it all within, say, 10 minutes. And so, but with that. let me just, I think we're coming to the last 5 minutes, and just time for some question and answers. So I think, yeah, so I think if there are any questions, and should we
I've got one here.
of,
Yeah, some great ones. Let me go to Wayne's question. He says, if you do not have your owner's salaries in your QuickBooks records, do you want to add that value to the worksheet? Absolutely, Wayne. That is so important. You know, I mean, this goes to not just simple numbers, but the book called Pay Yourself First, Profit First, or Pay Yourself First. All of these entrepreneurial rules about making sure that your business pays you and you are the manager. So absolutely, if you're taking draws or distributions, count that as a salary when you're doing the simple numbers calculation. Put your salary in there. And in fact, as you saw with the bouncy house, she didn't have much of a salary in that first quarter that we looked at. I would have advised her, put a reasonable salary in there. It's fake, right? But put a fake number in there so you know what your business is doing and you can build the company in order to provide the salary that you need, that you want in the future by plugging in a fake salary that you wish you had earned. But always pay yourself first. Always count your salary for any kind of financial analysis.
Very cool.
What else? Let's see. Can the consolidations pull from QuickBooks US or Canada? Chris, what are you working with Intuit Canada yet?
Yes, yeah. So I think the account structure is a bit different, I think for Canada. But yeah, so I think it's, we're able to pull in from, say, multiple entities, so you can reference, just that entity, and yeah, so you can report on that. And I think there might even be some Canadian customers, on this call as well. So
yeah,
absolutely.
Excellent. Anita asked the traditional question somebody's always got to ask: can they get a copy of the recording today?
Yes, absolutely. Yeah. No, we're so I think we did remember to start
You're recording on Zoom, and I'm recording on my local, and so it'll be on my YouTube channel.
Okay.
Chris and I'll work together to make sure everybody gets an update. So let's see. Oh, here we go. Mary Jo uses Fanatical now. She has 12 separate QuickBooks Online companies, and she merges them into a single aggregated, what do we call that, a roll-up business using Fanatical. And maybe you want to talk about that for a second, Chris.
No, well, thank you very much for sharing that, Mary Jo. And yeah, and I think that you've got, I think that particular customer, I think, is one of a very cool franchise, right? And so I think thank you for sharing that. And so that's very cool.
Yeah, franchise is a great use for roll-ups and aggregated. It's tricky, I do roll-ups for non-franchise companies, and it's tricky because their chart of accounts are always different. You've got a hamburger joint and you've got a personal trainer or a gym, and they have very different looking chart of accounts. But using Fanatical, you can point to different things and say, add the line over here that's called hamburger revenue, and add the line over here that's called gym membership revenue, and just add them together because it's a simple Excel formula. So yeah, great to merge all kinds of things.
David, and I think that's maybe just a question just in terms of the template, so do you have, or how would you share, this template? What are your thoughts? Is it sort of a standardized template? And so we've got, Wayne asking here just in terms of the template.
I would love to share my template with you, and I will be happy to put a link in our follow-up email to a place where you can download that right off my Google Drive. I'll also say that Greg Crabtree's simplenumbers.com, I'm not sure, but he has resources for free out the yin yang. He's got a bunch of formulas, maybe even a little bit too much. I tend to be a guy who simplifies until the end of the day. I simplify as much as I can. So Greg will have resources. If you really want the advanced lesson, find him online and grab some of his original templates. I will make my simplified template available to everybody on the call through an email link.
Yeah, David, no, I want to say thank you. I think that I'm read the book and, looked at Greg's stuff. But I think that, I just think even as a business owner, it's very easy to get overwhelmed. And I think you really articulated very well, what the key metrics are, why they are so important. And I want to say those, just those levers, those business levers, right? And just what you focus on. And so I just think you just present and say sometimes what is a bit more complicated topic. I think you just break it down very well. And so I'm very thankful, that
it took me, Chris, it took me a long time to make complicated financial analysis easy enough for my simple little brain. So
well, I think
I'm happy to pass that along.
I think we're definitely benefiting from that. And I think, thank you so much for doing that and, and for sharing with us today. And so, just want to say thank you very much. And thank you to all our participants. And thank you for joining. I hope you found this valuable and insightful and
reach out. There's our email addresses on the screen. Please reach out. Feel free to write a personal email to either one of us. We will answer.
Thank you. Thank you, David. Thank you, everybody. Thank you.
Bye now.
Bye-bye.